Well, hello everyone, and welcome to the pre-show. We're going to kick off our monthly coffee and real estate live chat here in about 13 minutes. Just going to go through real quick and make sure.
Hello everyone, and welcome to the pre-show. Well, hello everyone, and welcome to the pre-show. We're going to kick off our monthly coffee and real estate live chat here in about.
Where the heck is that even coming from?
Go through real quick and make sure.
Am I going to have to wear headphones today?
Am I going to have to wear headphones today?
Oh, I get where it's coming from. There we go. I tried something new this time, folks. So I've actually embedded the stream into my website, soldbyrobert.com. So it's actually there playing. Just because I could. In previous iterations, I tried to do it and it wouldn't work correctly. But this time it worked just fine. To the point where the audio just came on automatically. So sorry for that. But good that we check these things before we do the real deal. I can see YouTube is working. Let's check LinkedIn. LinkedIn actually is working. That's the first time in forever. And then let's check X and see what's going on there. And there it is. Right there. We are good. So I hope you all have had a great month so far. I keep trying to think if there's anything super big going on in October. The numbers will be kind of interesting in terms of looking at the trends. In terms of road trips, just because I'm kind of taking up this thing where on a regular basis I'm exploring markets that some of my clients have expressed an interest in. So I'm kind of going there, checking it out, getting some ground truth. And one that's been interesting to me has been sort of the Nevada market, but not Las Vegas. I'm finding Carson City, Reno, that sort of western Nevada, right along the Sierras marketplace has been more interesting to some folks that I've been talking to. Not to overshadow others. Some of the most popular places remain Texas. Florida has sort of fallen off of the map in terms of where folks are going, which is also another interesting thing. Prices in Florida are just cratering, and I think that's understandable given what's been going on there with hurricanes and everything else. But areas like Idaho, Utah have now been getting mentioned a whole lot more by folks I'm talking to who are considering moving. Some interesting conversations I've had with folks who are doing the return to office thing, right? A lot of companies here in Silicon Valley are doing the return to office. And so much of that is less about actually returning to office for some of these companies, and I think more about pushing people to quit. Because apparently in some of the follow-up conversations these folks have with their employers, it literally degrades to, well, you can either return to office or you can quit. And that seems to be the implied desired outcome for a lot of companies, which isn't great, right? Because that indicates continuing lowering of headcount, which is never good. And there also seems to be, just from articles I've been reading lately, kind of an interesting disconnect in understanding how. And I'm not a commercial real estate guy. In the early 90s, I dabbled. By dabbled, I mean simply researched. I didn't actually start doing commercial real estate. And I'll be honest, because the people in it were ridiculously annoying. And by people, I don't mean the people who wanted to rent stuff or get a business going, but the real estate agents involved. Very, very much of a cutthroat kind of environment, at least when I was doing it. Maybe they've all joined hands and started loving one another, but I doubt it. But people don't understand that particularly when you're trying to make estimations of where the markets are going, how businesses are doing. Just because companies are keeping locations does not mean that is a sign of strength, right? These businesses sign leases, and if they break the leases, there are huge penalties for breaking the lease. So I've talked to a few folks, a couple of them in Fortune 50 companies, where if the company had its way, they would absolutely close down offices in a variety of areas, from Santa Clara to Sunnyvale, downtown San Jose, but they can't because of these leases that they've signed. So instead of there being a genuine economic rhythm to that stuff, it's more about, well, when does your lease come up, right? Does it end at the end of 2024, or does it not end until the end of 2027? So I think that there's a lot of disconnect there. Of course, if a company goes bankrupt, poof, all that stuff just goes away. But I think that assuming that a lease is a moment-by-moment decision that a company makes as to whether or not they stay in a location doesn't really acknowledge the realities of how that tends to work in a business environment. So just some interest. It only comes up because that's one of the interesting conversations I've had with folks recently. And I get in way more real estate conversations than I'm sure the average person does, just given what I do. But there it is. All right, folks, we've got just about 6 minutes left until the stream gets going for realsies. We are up on all the various platforms, in addition to soldbyrobert.com. So if you are someone who... And if you're someone who wants to be able to actively participate in the chat. So just to give you a heads up, if you're a newcomer, and I know I got an awful lot of people on Meetup, I actually promote this event as well. And we got quite a few new members over the last month since last time. And if you want to be able to participate, you need to be in one of the things that will let me see the chat. So I'll see chat from YouTube. I'll see chat from Facebook. I don't believe I'll see it from X. But LinkedIn, Facebook obviously is sort of the original home of the show. And I've got stuff set up. And for those folks who can chat, if someone chats to me from a platform you're not on, then you'll see it up on the screen. I've actually got the chat embedded there, with the exception of Facebook. The Facebook chat is not embedded. So, and I also created this morning as a last-minute thought for the fact that there is no indicator of the pre-show. So I thought I'd do that. I'll obviously want to come up with something a little bit more interesting, maybe for next month. But I hope you've all brought your favorite brew. I frequently will have mine in one of those thermos things to keep it warm throughout the whole live chat. But this is my favorite mug. One of my sons picked that out for me at Disneyland when they were little guys. So, it's got the sentimental thing going on. It's also kind of a cool mug. It's in the part of the park that's right across from the Jungle Cruise. So it's got a bunch of animals on it. So that, I know that has nothing to do with real estate, but that's what the pre-show's for. Anything and everything is valid. So if you've got any questions, feel free to throw them out there, and I will be happy to try to answer them. I think last time I had started subscribing to a new data source for real estate data, and obviously we'll be able to share that again this month. So if we have any questions for anywhere in the country, because this is a tool that lets me look at various numbers, not just for our local area, but anywhere in the state, anywhere in the country. So if you've got a burning question about an area that's way outside my my service area, I'll be happy to see if that looks interesting. We've got some interesting data this week or this month relating to the hot markets as some folks are evaluating it. And we'll see that it's not a huge shocker on how many California communities are represented there. But I've also got a question on how they're coming up with that, because it seems like one of the big metrics that they're looking at is how many visitors there were to a property. And I'm not, that's a little bit of a soft piece of data that I think we'd have to look a little bit more into before we come to any conclusions about. We are just 2 minutes away from starting the show. I want to thank those of you who've joined in. I can see on a couple of different platforms we've got some folks watching. Thank you very much. I appreciate you spending your valuable Saturday morning with me, and hopefully we'll walk away with some great information in terms of understanding how our local market's doing in Santa Clara County, San Jose, Morgan Hill, Gilroy. And the reasons why I select those communities is obviously it's from a super 10,000 foot view all the way down to a smaller community like Gilroy. But it also kind of reflects areas that I tend to focus on. I actually live in southern Silicon Valley, and I live in Morgan Hill, so it's just more of a convenience than anything else. But I do love the area down here. I tell you, when I moved here, I've lived in San Jose, I've lived in Mountain View, I even lived in Santa Cruz for a while, when I was in Aptos for a while. But there is such an amount of decompression that happens when you leave sort of the heart of Silicon Valley and sort of head south to Morgan Hill and Gilroy. I think there's a certain amount of peace that comes from living down here, where you don't feel like you're right on top of each other. And man, I'll go and I'll look at some homes in South San Jose or in Central San Jose that are just right elbow to elbow with everybody else, and it can be a challenge, and particularly for folks. And obviously, I don't have personal experience with this one, but those apartment complexes that hug the 85 freeway, the southern end of it in South San Jose. Man, I don't know how those folks managed to live in there so crammed together. I was never a huge fan of that particular development. But, I'm sure it fills a need, so great. But there's so many of them right there, literally right across the freeway from each other. It's kind of nuts. All right, we're just 10 seconds away. And then we're going to jump in and start talking real data here. Again, feel free to ask any questions you might have in the chat. I'll be happy to answer them to the best of my ability. And I want to also thank folks. Well, we'll start that off in a second here. All right, folks, here we are. Welcome to Coffee and Real Estate Live Chat with me, Robert Whitelaw. I'm a licensed real estate broker right here in California, servicing Santa Clara County, particularly the South County area. I've been doing this since 1988, so a very long time. I'm also a seller representative specialist, a certified residential specialist, a luxury home certified agent, an e-pro, and of course, as I mentioned, a licensed broker and realtor. So if you've got anything real estate related you'd like to chat with me about, or any goals you're trying to achieve in real estate, feel free to reach out to me. You can find me at soldbyrobert.com. So with that out of the way, let's go ahead and jump in to this month's Coffee and Real Estate Live Chat. And again, I hope you've brought along your favorite brew. I know I have, and then this morning, which is, I don't normally just do it in an open mug, but this is kind of my go-to mug. And I've got some good mocha in there this morning, so we'll see if that's the fuel I need to get through. So what we can do is go ahead and jump in and look at the numbers. I'm trying to think if there's anything I should tell. I was about to tell you something as the pre-show was wrapping up, and now I can't remember what the heck it was. So I guess we'll just jump in, and if it comes to me, it comes to me, and if it doesn't, it doesn't. So let's go ahead and jump in. And we are going to hit the important data here. Now, as usual, we start off with the total homes on the market. So think of this as the total inventory, what was available. If you're a seller, this is the competition. This is how many homes you had to compete against in terms of trying to get the attention of buyers. If you're a buyer, this is the total inventory you had to choose from during the month of September. We can see that here in Santa Clara County, inventory was up. And again, this is year to year. In other words, comparing September of last year to September of this year. And the primary reason for doing that is to eliminate seasonal influences, right? We don't, comparing a January or a February to a December doesn't make any sense. very different. Different things happen, and then different things should happen, right? Because they're different times of the year. We'll look at month to month later in this data, but this is a way to totally get a grab of the data that's relevant to this month, to the month of September. All right, so we can see that we're currently at 1,765. Now, that's a 37% increase from the same time last year. So last year it was 1,284. That is a pretty big increase in inventory. We've been screaming here about inventory being the key metric for a very long time. And the big question is, does that meet demand? What does that end up attacking? Now, at the same time that we see this number up so high, we're also seeing interest rates went up, and we're seeing mortgages tapering down. But we're also at that time of year when things tend to slow down anyway. So we'll continue on through this, and then we'll try to look over our shoulder, see if we can't figure out what might be going on the market. Now, in San Jose, the number's up even higher by percent. So it's up 40% from the same time last year. We had 585 homes on the market in San Jose last year, 818 this year. Morgan Hill is up 44%. 61 homes last year, 88 homes this year. Gilroy up 36% from 72 homes last year to 98 homes this year. So across the board, regardless of sample size, right? And for those of you who are new to the show, one of the main reasons I do Santa Clara County overall is because of sample size, right? It's better to have thousands of data points than dozens of data points like we tend to get with smaller communities like Morgan Hill and Gilroy. It just gives us data that I think has a higher level of reliability. And that's not me saying that. That's just statisticians in terms of what they look at. But it also is at least a way to get a little bit of a look into what we're experiencing in these smaller markets. So let's go ahead now and jump to the number of new listings. Now, these are homes where sellers decided to put their home on the market in the month of September. We can see that across the board, once again, we see this number rising. So compared to the same time last year, we've got 1,545 homes overall in Santa Clara County that were put onto the market. That's a 29% increase from the same time last year, which was 1,195. San Jose up 34%, so an even bigger jump. 568 homes last year, 759 homes this year. Morgan Hill, really a wash. I mean, at just 3%, given the small sample size, we can just call that about the same as last year. So 59 homes last year, 61 homes this year. Gilroy, 42 homes last year, 61 homes this year, for a 45% jump in the total number of homes that were added to the market. And that's interesting as well, because what we're going to look at here in a minute, as we look at homes sold, once we compare all these numbers together, we can see, are we adding homes to the market? Are we adding to inventory as we move through the month, or are we reducing it? So there actually have been months in the past where we sold more homes than we listed. Well, that didn't happen this month, and it actually hasn't happened for quite a while. But we can see from these numbers that in Santa Clara County, the total number of homes sold only increased 6%. So think of that for a second. New listings increased 29% from the same time last year. Active inventory increased 37%, but the total number of homes sold only increased 6%. Now, right there, you are getting a feel for what's happening in the marketplace, which equals a dramatic increase in overall inventory going forward. So last year it was 871 homes. This year it's 926 for a 6% increase in Santa Clara County. San Jose, 8% increase. 449 homes last year, 487 homes this year. Morgan Hill is 0% change. We had 37 homes sold last year, 37 homes sold this year. Gilroy down 14%. So we actually sold fewer homes in Gilroy, 29 last year, 25 this year. And honestly, at these numbers, I would just call that a wash. Remember, sample size, so the margin of error increases with a smaller sample size. So I'd just say Morgan Hill and Gilroy are on par with last year, right? Next. And as I said, this is what we can use to gauge, are we adding or subtracting from inventory? So in every case, we're adding homes to inventory. And in Santa Clara County, that means we added 619 homes just in the month of September to the overall inventory. When we take the amount of homes sold versus the amount of homes listed, that's how many homes we added. In San Jose, we added 272 homes. In Morgan Hill, we added 24 homes, and in Gilroy, we added 36 homes. So across the board, we just contributed to more inventory, which is obviously going to push more days on market, not just days on market, I'm sorry, but a month of inventory. And we'll take a look at that here in a second. Okay. So months of inventory. Let's understand what months of inventory is. If we took the month of September and we froze the inventory and we froze the number of homes sold, how long would it take to sell off that inventory, selling the exact same number of homes every month? And that's what this number represents. And two interesting things about this. One is, do they all increase? And in this particular case, they absolutely do. And remember, we're still doing month to month. So there can be no argument that, well, it's normal at this time of the year for us to see this number going up because we're comparing it to the same time last year. In Santa Clara County, it's up 27%. It was 1.5 months last year. It's 1.9 months this year. So, and to get a sort of a national calibration to what this number is telling you, the national equilibrium number is about 4.5 to 5 months of inventory. That's considered normal. I would say in Santa Clara County, more balanced is, say, 3.5 to 4.5. So I think it's a little less, just from my personal feel on how the market works. And we've kind of crossed a point here, at least in one community, where we're very close to what I think is a balanced market. That's the first time I've been able to say that in a very long time. But in all areas, we're definitely heading towards that greater balance. And when I say balance, what I'm saying is that buyers and sellers have about equal power in the market, right? It's not a seller's market. It's not a buyer's market. It's more balanced. But so in Santa Clara County, it was up 27% to 1.9. Still represents a strong seller's market, but it is definitely increasing and moving more towards a buyer's market. San Jose up 31%. It was 1.3 months of inventory last year. It's 1.7 this year. Morgan Hill up from 1.6 last year to 2.4 this year. That's a 50% jump. And Gilroy, 2.5 to 3.9. That's a 56% jump. And at 3.9 months of inventory for Gilroy, I would say that is well within the margin of a buyer's market. And I think that is something that is worth knowing for everyone. I know I've been sort of an advocate for the Gilroy market. I think you can buy smart in Gilroy and get far more bang for your buck than you can in the markets to the north. If you're willing to add that extra, I mean, the difference, depending on where you buy in Gilroy, that commute increase can be anywhere from 10 to 15 minutes. But it really depends on where you end up buying in Gilroy. But I think that's a very interesting number in terms of showing us where the market's going. That 3.9 months of inventory for Gilroy is a mind blower, particularly when we consider where we've been, where for a very long time we had months of inventory under 1, like 0.8, 0.9, 0.6, and now we're sort of moving up. In Morgan Hill, we've got 2.4 months of inventory, and again, still moving towards being a buyer's market. Now let's go ahead and jump forward, just doing a quick look over at the chat to see if anybody's asked any questions. The next bit for us is going to be the home pending or contingent numbers. And this basically means accepted offers, right? So in the month of September, this represents the number of homes that went from active to contingent or pending. And that just indicates that an offer was accepted. And also gives us a leading indicator of how many homes we might see being sold in the following month, since it takes about 30 to 45 days for escrow to close on these homes. Now we can see from the same time last year, 14% increase in Santa Clara County. 884 last year, 1,005 this year. San Jose, 438 last year and 503 this year. That's a 15% increase. Morgan Hill, 43 last year, 40 this year, for a drop of 7%. And Gilroy, 37 to 34, which is an 8% drop. So just to recalibrate you here, we've got giant inventory increases in Gilroy. We're going to see what is happening with sales prices. But if any interpretation of data in your head is clicking, it should be, wow, Gilroy is looking like an opportunity potentially. And I think that's exactly what you should be taking away from these numbers as we move through them. I think Gilroy does represent a great opportunity. Places like Morgan Hill, I think, can represent an opportunity, but it's going to depend on where you're shopping. But you're still going to pay a premium to move just those few miles north to purchase in Morgan Hill. All right, let's go ahead and jump down here and take a look at average original list price. And I always need to explain this one. I know for those of you who've been listening for a super long time, it's tiresome to hear this explained every time. But the original list price, because I think it's a super valuable number and nobody else reports it. And it gives you an insight into the mindset of sellers. And if anything is going to help you negotiate the best possible deal for a buyer, it's the mindset of the seller. And this represents the very first number that a home seller agreed to when they listed their home for sale. So set the scene here. A person decides, you know what, I think I want to sell my house. So they start talking to real estate agents, and each real estate agent comes in and does their little pitch, and they do a market analysis, and they tell them this is what we think your home will sell for. And the seller may say, okay, that's a great number, or no, I think it should be this number. But the point is, it's the number that the seller agreed to. When they listed the home, they said, okay, this is a number that I think makes sense for getting my home sold. And in Santa Clara County, it was up 7.9% from the same time last year. So seller expectations of what they should get for their home in Santa Clara County were up by 7.9%. That's kind of the mental takeaway I'd like you to go with in terms of what sellers on average were expecting to get for their home. So that was $1,985,404. Last year, it was $1,840,140. So a good chunk of an increase there in terms of expectations for Santa Clara County. And there's going to be an interesting one here in a minute because it's totally not characteristic for that community. San Jose was up 6.8%. Last year, sellers' expectations were $1,404,062. And this year, it's $1,499,729. And again, that's a 6.8% jump. Morgan Hill, and this one blows me away. Morgan Hill is typically a community where everybody thinks their home is worth more. I do market analysis for an awful lot of people on a regular basis. And I come in with real numbers, right? And for those of you who might be considering selling, if a agent comes in and tells you a price that you should sell your home for, you should expect them to bring data. You should and hopefully you've done some of your own research. Maybe you've signed up for a regular monthly free market analysis, a digital automatic one. And if I offer those, so go to soldbyrobert.com and you can just enter your address and you'll get an instant market analysis without me getting your email or anything else. So it's just a great way for you to do a quick check. But let me suggest you subscribe so that it happens monthly and you get it in your email box, simply because in addition to giving you that monthly estimate of your home's value based on current market conditions, it gives you dozens of other tools that are great that I think every owner should be doing. And I suggest all my clients do some of these things on a yearly basis. With this, you're getting it done every month. And I think it's great to be informed, whether you plan on selling or not. Anyway, again, so San Jose, 6.8%. As we are now talking about Morgan Hill, last year, $1,567,068. This year, $1,574,539. That's a 0.5% increase. And this is very uncharacteristic. Typically, Morgan Hill sellers expect way more for their home when compared to the same time last year. So that's actually kind of refreshing. Morgan Hill has historically been kind of out of whack when the market takes a downturn. They've tended to be very slow to respond. And this represents that. The fact that this is happening this month and didn't happen 6 months ago is telling. Gilroy, interestingly enough, is up 10.1%. In looking at these numbers, I think that's more representative of the fact that some higher priced properties listed in the month. But these are expectations. So $1,154,530 in Gilroy last year, $1,270,637. But when compared to these other communities, despite the fact that being an over $1 million market, it still represents a relatively good deal. But because of the other numbers we've seen, the increased number of homes on market, the increased number of homes being listed, and the other indicators that we've been looking at in terms of robustness, in terms of what's happening in terms of sales, it gives you a lot more elbow room as a buyer to be more aggressive in the offers that you make. But then again, these are expectations. This isn't what things sold for. This is what people expected their home to be worth when they listed them in the month. Okay. Now let's go to sales price. And we'll see what the disconnect is. This is another one of those numbers where we can take the difference between expectations and what homes actually sold for and figure out how much below expectations were homes selling. So in Santa Clara County, the actual sales price was up 3.7%. So when we compare that to last year, expectations were up 7.9%, but actual sales prices were only up 3.7%. So falling far short of what sellers were hoping to achieve in terms of sales price. Last year, the number was 1,847,612. This year, the number is 1,915,641. When you do the math, that means that these numbers fell $69,763 below expectations when compared to what sellers were hoping to get in the month of September. If we look at San Jose, the number's actually down 0.6%. Which is huge. Last year, 1,481,405. This year, 1,472,547. What's interesting about this number, and this is really an anecdotal observation on my part, I tend to go and view an awful lot of homes that get listed in San Jose. And one thing that I've noticed is an awful lot of homes that were rentals have been put on the market. This may have something to do with the fact that California is now doing a lot more just statewide rent control, which is distressing. But I think that's an interesting development that on average homes are selling for less in San Jose than they were a year ago. Despite that, and because of that, it still represents a shortcoming when compared to expectations. Sellers on average were getting $27,182 below expectations in terms of home sales in San Jose. In Morgan Hill, $1,449,862 last year, $1,520,350 this year. That's a 4.9% increase from the same time last year. Expectations were 0.5%. So in terms of what sellers are actually getting in Morgan Hill, they're doing pretty well. They're getting more than they expected when it compares to the original list price, but it's still the total amount comes up less to the tune of $54,189. So I find that interesting. That we've got this thing where they're getting more. I think I misstated that. So I was referring to the year over year part in terms of the not getting what they wanted to get, but in terms of the actual sales price, the Morgan Hill number is a loss of expectations of $54,189. So the overall hope of sellers was a certain amount, and it was $54,000 below that is what they tended to get, but the percentage increase in what they expected was only up 0.5 point, while the actual amount they were getting was up by 4.9. Does that make sense? I think I may have just made those waters even muddier. But anyway, when you look at the actual number versus expectation percentages, it's a bit of a flip-flop between what they got and then what they expected. All right, sorry. Man, that's a shiny thing I shouldn't have turned towards on that conversation. Now, Gilroy is up 1%, $1,247,092 last year, $1,259,900 this year. So up a bit, but again, given the small sample size, I'd call that a wash compared to last year. So we'll see what happens in this market. But I honestly believe that when we see the other numbers, when we talk about the total number of active listings, when we talk about the total number of homes listed, and remember, there's a 45% increase in listed homes in Gilroy in September. When we talk about the total number of homes sold being down 14% in Gilroy, and when we talk about the months of inventory increasing to 3.9, that all spells to me a much stronger buyer's market. And we're also heading into the time of the year when things tend to turn towards buyers anyway. A lot of buyers will stop shopping in the winter months, and a lot of activity tends to drop as soon as we go into November and December. So I think a lot of these numbers should inspire potential buyers to looking in Gilroy as an opportunity. And again, I know I've said this before, plenty of amazing places to live. Right around Christopher High School, Northwest Gilroy, Northeast Gilroy is if you're someone who's at a higher price point, those are some amazing homes out there that typically come with acreage. So depending on what you're looking for, Gilroy can definitely still be good. You're going to get that straight up suburban vibe, Northwest. You're going to get the little bit more acreage vibe, Northeast. But that's just a way of satisfying what because if you're looking for that acreage in Morgan Hill, you're going to spend multiple millions, right, to get something in that realm. All right, let's go ahead and take a look at percent over under asking price. And this is an interesting one. This basically tells us how much above or below asking price, right? If this number is 100%, that basically means on average, homes are getting their asking price. So let's talk about it for a second. Santa Clara County, last year it was 104.7. This year it's 104.1, which means that this year homes were selling for approximately 4.1% over asking price. A lot of baggage goes with that number, including when you see these numbers, you should be thinking that the reason why a home sells for over asking price is multiple offers. So overall in Santa Clara County, while it was a 0.6% net decrease in the percent of asking price, homes are still tending to be stronger on the seller's side because they're getting multiple offers. Not always the case. Remember, Santa Clara County is a huge area. So there are going to be areas where homes are selling for below asking price. But on average, this is what we're seeing. We're seeing a scenario where sellers are getting above asking price. Interesting drop in San Jose because it's the biggest drop. It's a drop of 1.9%. And last year, 105.3, meaning last year, homes were selling for approximately 5.3 over asking. This year, a bigger drop than we saw numerically in terms of overall in Santa Clara County, 103.4. So homes were selling for 3.4% over asking price on average. Morgan Hill down 1.4%. Last year it was 101.2. Now it's below 100% for 99.8%. So 0.2% below asking price. And from here, we should expect this number to just go down more, right? This is for September. I don't see any reason why October, November, December would see an increase in the percent of asking price. Gilroy actually saw an increase, 99% last year, 99.1% this year. But again, given sample size, I just call that a wash. I'd say that it's about the same as it was last year, but still 1% below asking price, right? So the average home in Gilroy is selling below asking price. So that's, again, another reason to look at Gilroy as a place where you're going to be able to come in and make offers below asking price and have a good probability of them getting sold, getting your offer accepted. Next, let's take a look at, where are we at? Days on market, I believe, is our next number. Let's go ahead and punctuate that with a little something on the coffee side. And again, I mean, a quick look at these graphs is going to tell a story. Okay. Now, Santa Clara County is up 26%. It was 19 days last year, 24 days this year. And I know I've given this speech before, but for the new folks, anything from 14 to 18 days is a minimum number for days on market. Because when agents list a home for sale, on the listing, they'll say, we're not going to look at offers until such and such a date. And that's almost always 2 weeks out because they want to have a certain number of open houses prior to them considering any offers seriously. Once you start getting into the numbers we're seeing here, there is no question that is a real market thing, meaning they didn't get offers immediately after their whole window of time. And that window of time can be super small. I've seen agents do it as little as 7 to 10 days. But last year, again, it was 19 days, 24 days this year in Santa Clara County for a 26% increase in total days on market. San Jose, 22% increase, 18 days last year, 22 days this year. Morgan Hill, 17 days last year, 37 days this year for a 118% increase. And in my own hands-on experience, this is absolutely a real thing. And it's happening in a mainstream way, kind of across the board. But once you get to properties over 1.3 million, it's even more than 37 days. And And I know we've had a couple of bumps on the road. I know early in the year with a listing I had, we listed the exact same, like 5 days after a dramatic increase in interest rates, which really hit buyers at that time and kind of had them rethinking and delaying. Interestingly enough, I think we ended up selling to a party that actually saw it in that first 2 weeks, but simply didn't want to take on a loan at that interest rate. And I think it ended up adding 2 weeks to what I had projected as the total days on market. But again, that was based on the numbers prior to that dramatic increase in interest rates. In Gilroy, oddly enough, we see a drop of 80 days last year to 36 days this year for a 55% drop. Now, in all fairness, when I go back and look at the Gilroy data, what we saw was an awful lot of homes that had been on the market for a very long time sold in the month of September last year. So it's a little misleading because that was definitely a peak month for Gilroy, but still a real number. So things are still on par. And I think it's interesting to simply compare it to the other communities, right? So 36 days in Gilroy, 37 days in Morgan Hill. So it's definitely in that ballpark of what we would expect given the overall trends in other communities. Next, let's take a look at overtime. So this is strictly linear going all the way back to March of 2022. And the first one we're going to look at is total active listings. And we're going to look at this and try to use it as a template to anticipate where things are going to go in the future months. And we can see that from August to September, we had an increase in the total number of average listings. Last year, in 2023, from August to September, we had an increase, but not as dramatic an increase. In August of 2022 and September of 2022, we actually saw a decrease. Normally, and I think maybe last year was a bit of an anomaly. I think just given the time of year, we normally see this number drop a bit. But it really depends. If you don't see sellers going off of the market, say in November, right? And we obviously haven't hit November yet. But you know a seller is very serious when they don't take their home off the market in November. A lot of sellers take their home off the market in September and in November, December, simply because they don't want to deal with people coming into their house during the holiday months. So we'll see how this goes in the future, but that's a pretty dramatic increase. Last year, we saw things relatively flat between September and October. And in September to October of 2022, we actually saw a decrease in inventory. What do I think is going to happen with inventory? I think it could flatten, but I think it's going to remain kind of at that level. Well, its trajectory is kind of crazy. I'm not sure if it's going to make a big change. I know from September to October, last year it was flat with a big drop in November. Wouldn't surprise me if we see something similar to that in terms of the trend line. So I would look for a flattening with a follow-up downturn as we go into the ending months of the year. So next on this hit parade is new listings. We can see a pretty dramatic increase this year. Last year, there was a drop between August and September, and there was a drop between August and September of the year before. Now, whenever I see things that tend to defy all the typical market trends, it makes me wonder why those things are true. And in this case, I think there are a lot of folks doing profit taking. I think what we've got is a scenario where people are wanting to strike while the iron is hot. It may indicate a concern on the part of homeowners that they had this plan to get their home sold at a certain time, but they're seeing property values going down. If you look at an awful lot of different data sources compared to previous months, home values have gone down across different markets. I know there's a lot of headlines talking about that. Not so universally applicable in our marketplace, but this may reflect sort of that concern on the part of sellers that they're kind of hitting when they can. To be really honest, if you find yourself in this particular boat, I think you need to get a hands-on market analysis of your property. And I wouldn't put your home on the market now. I would put my home on the market in January, February, but I'd start preparing my home now to get it ready to be marketable. And that may include painting. It may include storage of too much stuff you may have in your house, packing of certain things that you don't need, but focusing more on preparing your home to be sold rather than putting it on the market before the new year. So where do I think this is going to go? I think we should expect it to decline from here. But that is such a dramatic increase and so counter to past years for September. I don't know. It really depends on how stressed out people get. With the latest slight uptick in interest rates, which obviously usually reflects a lower interest on the part of buyers, folks may not be as enthusiastic about listing their home in the coming months. So we'll see how that plans out. Next, how many homes got sold? We can see we've been trending downward since May. If we look at last year, we can see that the trend from August to September was also down, but the trend from August to September in 2022 was up. So an interesting number, 2022 was also when interest rates took that crazy jump in March, which kind of peaked at the end of 2022. And I'm not real sure where to go with this one. Do homes continue to decline in sales? Historically, we say yes. Historically, from here, number of homes sold tends to continue to decline right up until we hit January. And then it usually makes a turn back up when we get into February. And remember, homes sold is a lagging indicator to pending, meaning pending tells us what's likely to close next month. And then sold tells us what did sell in that particular month. So now let's go ahead and take a look at pending. We can see pending is down as well, which indicates we'll see a decrease, a downturn in home sales next month. So I don't see any reason to expect home sales to increase. What's also interesting is in the last few weeks, I've noticed an uptick in the number of escrows that fail, which is also interesting, not just in this market, but other markets that I look at. I'll get an email when a home comes back on the market that I had previously tagged as a property. So it's happening not just here, but really across the board in an awful lot of areas. Okay. Next, let's take a look at average list price versus original list price versus sales price. We can see that they've crossed the streams here, where average list price is above average sales price. We can see that's happened a few times, but we've really been in a marketplace where sales prices have been exceeding expectations for a few months, right from March of 2024 right up until July of 2024, and then things switched in August, and we're seeing that continue in September. So if we look at last year, we can see that that's not really where we were. Things were selling for about what folks expected, and in October, kind of staying on par. And then we saw sales prices drop in the beginning of the year versus list price. The year before that, average list price way above what homes were selling for. Where do I expect? It's interesting that we're seeing this separation happening now. I would expect this separation to increase. In other words, I would expect there to be a bigger distance between original list price and sales price, with sales price continuing to drop and original expectation to either continue to increase or stay flat where it is. And let's see here. Here we are with just a plotting of going all the way back with percent of asking price. We can see that we peaked way back in March of 2022 at 15.3%. That makes total sense. Remember, interest rates started to go up in March, and then there was this dramatic drop in May, June, July, and we never really started going back up from there, where we peaked up again in March and April of this year, where interest rates were a little bit more manageable, but we've dropped back down. If we take a look at the trend here, I think that we can expect continuing decrease. We always tend to see it right in here in January. It tends to bottom out December, January. Again, December, January, it bottoms out. So from here, I would expect this to drop down more. But we can see that in the summer months this year, we definitely outperformed the summer months last year. Next, let's take a look at days on market. We can see we're not at the peak that we look at over the last couple of years. We can see there was one in January of 2024 and again in January of 2023. So why do we see that peak? It's a sell-off, right? Whenever you see this, it's not necessarily a reflection that the market is softer, but actually stronger. Why? January, we see more buyers come into the market, and homes that were sort of sitting on the market for a longer period of time suddenly get sold. It's selling off older inventory because we've had a jump in the number of buyers. So it's not, in this particular case, it's not a negative indicator of the market. It's an indicator that activity has increased, not decreased. And a lot of people misinterpret that data because it has now focused on the selling off of property that sat on it through the entire winter when there were fewer buyers out there. So I expect us to see the same thing happen as we move through this season. I would guess that we may actually see, just given the trajectory, right? I mean, look at where we are in September of 2024. If we look at September of 2023, look at how much higher we are now. If we look at September of 2023, it was obviously higher then. My expectation would be we come close to this peak that we had on January of 2023. It may go even higher. I mean, when you look at the rate of increase here, I think that's pretty substantial. But we'll see. The market overall is tending to lean into it, taking longer to get homes sold. If interest rates continue the way they are, where they're not really going down, they've gone up a little bit, that could soften the market for buyers and have them looking elsewhere or stepping out of the market entirely until they see something that they can interpret as beneficial. Next, let's take a look at the total number of homes that have had price reductions in their list price. So last month for Santa Clara County, it was 24%. 24% of homes, about a quarter of homes, had a price reduction. This month it's 23, so it's down a little bit, but year over year it's a 48% increase. So 48% more than the same time last year. In San Jose, same number, 24%, 22% this month, which is a 57% increase in the same time last year. So far more homes being reduced in price this year than last year. Morgan Hill, 25% last month, 32% this month, which is a pretty substantial increase. And that's an 87% increase from the same time last year, with Gilroy having 26% last year, 30% this year, for a 53% increase. So this is actually just simply an indicator that sellers are getting it. They're getting updated information. Maybe they listed when things were going a little bit better. I think this is going to increase as we head through the end of the year, because the market has changed a bit. We've seen a dramatic increase in inventory in a lot of these markets, which is just a competition number. So if you want to get sold, then you need to reduce your price. It's one of the few things that you can control in terms of how to boost the attractiveness of your property. What the real shame here is, as I look in each one of these areas, I find homes that are obviously overpriced from the get-go. And I don't see how any market analysis that might have happened leading up to that home going on the market that would lead them to believe they should list at that price. In fact, the strategy that I think is smarter now is to go with a market analysis and then look at your competition in that marketplace for homes with similar square footage, bedrooms, and amenities, and undercut that by $1,000 or $5,000 or whatever. And if you've also done a market analysis and seen that there's banding happening in your market, where, for instance, banding is very interesting, and I see it happen in a lot of markets where, in terms of activity, homes getting sold in this weird price range. Let's say there's a market where from $500,000 to $1.2 million, homes are selling like crazy, right? In terms of the overall inventory in that price bracket, far more homes are selling in that price bracket. And then in the $1.2 to $1.4 million range, it's down a little bit. And then in the 1.5 to 1.7 range, it jumps again, right? Well, if you're in that middle band, actually raising your price into that next higher band would probably make sense, since there's a higher level of activity at that price point. But can also go the other way, where you can have a weird inversion in those bandings, where you're in a weird band where sales drop. And maybe it's not so weird, because simply at that price point, the searches that buyers are doing in those markets are simply not revealing homes above a certain amount. So that is one of the reasons why price banding happens. But let's say you're priced at $1,275,000 and you're finding that up to $1.2 million, a higher percentage of the homes are selling. Well, by going to $1,199,000, you're going to dramatically increase the amount of people's eyeballs that end up seeing your home, and you're going to get a much higher level of attention to your home with a higher probability of selling it for above asking price. So I think that's a strategy that needs to be considered by an awful lot of buyers or an awful lot of sellers right now, because we do see that happening in a variety of different markets. Okay, let's see here. That about covers it for our data this month. If anyone's got any questions, feel free to ask in the comments. I am not seeing any questions yet, but of course, if you have one, I am perfectly happy to address it for you. What we can do now is jump over to some of the news items that I've been accumulating for you since last time and discuss those. So let's jump in and take a look. And the first one we're going to hit is September 2024 hottest housing markets. I bring this up really just to sort of give you a calibration to what happens in Morgan Hill, or not Morgan Hill, but in our markets. Notice here, these are the hottest metros, and this was one where I was bringing up things like viewers per property versus US 3.4. I'd love to find out how they're calculating these hot markets, but if we scroll down the list, we can see there is not a single West Coast community in here. So I think that's an interesting one to note. But if you're someone who's looking at getting into an investment scenario and you're okay with long distance, some of these housing markets may be attractive. We can see that, in Rockford, Illinois, 223,000, relatively low barrier to entry, 305,000 in Oshkosh, Neenah, Wisconsin, 230 in Akron, 259 in Canton, Massillon, Ohio, 240 in Erie, Pennsylvania. And if you're looking to do an investment simply by getting one of these properties and handing it off to a property management firm, if you do the math, you can definitely be making positive cash flow. One thing to keep in mind is how friendly are these states to landlords? And that means you having the flexibility to either do a month-to-month rental or short-term rentals. A good example here is I completely divested from Hawaii, for instance. As some of you know, an example property I've brought up before for short-term rentals was a property that I owned on Oahu. And Oahu has proven itself continuingly hostile to property owners who want to do short-term rentals. And when you look at the politics of the island, it makes sense. The hotel lobby is very strong. And while people are going to want to chant about preserving neighborhoods and these other types of things, what's really happening is the hotels don't like the competition. So the hotels tell their politicians, we need to kill this. And so they do. And that has been happening now for years. I've brought it up lots in my podcast and also here. So I divested. I pulled my money out, and I'm glad I did. I've looked at what property values have done in the areas where I was invested, and things have gone down since I left. So yay for me, I guess. But now I'm looking for a new place to go. And California it's a tough one because the appreciation that you get in these markets here is very different from a market you might see like in a state like Nevada, which is super property value friendly, or not property value friendly, but property rights friendly, and makes it once you're outside of an HOA, it's your property. You still have something that looks like property rights in Nevada. So I've been looking there. And maybe it's because I have a bad taste in my mouth from my experience with Hawaii, but I find that to be one of the first things I do. If I see a market where the numbers work, my very next thing is to Google what limitations does this state, county, or city put on short-term rentals. I am kind of an absolutist when it comes to property rights, and the idea that the state can tell me how I can or can't rent my property that I own is annoying to me. So I like to focus on states where their restrictions are either non-existent or very, very light touches. But you have to try to figure out where it's going from there. Hawaii the signs were there years ago. In in terms of the rhetoric that was going around, but also in some of the things that they were doing, trying to tax you to death as a landlord. But it finally got to the point where it just wasn't worth it for me. All right, next. Weekly mortgage demand tanked 17% after interest rates hit the highest level since August. The average contract interest rate for a 30-year fixed-rate mortgage with conforming loan balances increased to 6.52% from 6.36. Now, interestingly enough, I am currently looking at I have a loan in place for me to potentially make my investment purchase. And the rate I am currently at, and we're going to look at interest rates here in a minute, my rate was up because it was going to be a non-resident. It wasn't going to be my residence, my official residence, so I have to pay a bit above what folks could get. But I'm finding my rate is still about where it was when I first got approved a month ago. Refinance demand fell 26%. Week to week, application for a mortgage to buy a home dropped 7% for the week. In terms of other stuff, weekly housing trends, just to kind of get a comparison between the nation and us. And these, they don't have their little days on market up 8 days. We can see we've kind of been in the same boat compared to last year. New listings, not sure why there's an asterisk there, but active listings up 29.7%. Our new listings in Santa Clara County were up 29%, so right on par with the national stuff. Median list price, this might be a weekly thing, but our median was obviously up compared to last year. Mortgage rates up to 6.44%. We already kind of discussed this. I liked this one because it gave you sort of a comparison chart to see where we were versus where we are. The peak obviously was late last year, and we saw a bit of a dip with a little bit of an increase most recently. New construction activity slows in September, which is normal in terms of just understanding the year. But what's interesting is it was a decrease of 2.9% from the previous month, which is fine. Month-to-month data has its place, but not for making big decisions. 5.7% from the previous year. So it's down from the same time last year. Housing starts slowed as well, falling 0.5% from August 2024 and 0.7% from September of 2023. Completions dipped by 2.7% month over month, but remained up 14.6% year over year. Now, one thing that I like about what's been happening is we've seen more, and they say here primarily in multifamily space, this is where this slowed. I like single-family residential development. I think it makes the most sense. It is the more desirable. Now, having said that, I think that a market that is more balanced in the types of single-family residential homes that are being built makes more sense. And so much of the single-family residential development is the 2,700 square foot, 4-bedroom, 3-bath, and that's what we need is more entry-level homes, 2-bedroom, 3-bedroom homes. That I think are perfectly fine and represent excellent stepping stones. In order for those to work, though, we need to stop beating builders over the head with fees and taxes on getting those homes built. If we want homes to be built, we need to get off of their back in terms of both fees and crazy regulations. Because remember, in that time period from 2000 to 2007, as state, county, and local governments saw so much growth in home sales prices, they wanted a bigger piece of the pie. So they started all of these new fees, all of these things that builders had to comply with that would make them money or get them a bigger piece of the pie. But then none of that stuff got taken away when the market crashed. All of these various entities kept those fees high. So I think if we were to pull back, if we just went to 2000 level regulations and fees, we would see a whole lot of the housing problem go away. Next, California Coastal Commissions. And for those of you who've been following me for a while, either on Twitter or here, I am not a fan of the Coastal Commission. Political retribution against Elon Musk. I found this one interesting just because it is so symbolic of the Coastal Commission, because I watched the hearings where they were turning down Elon Musk's desire to have launches happening in California, and in their discussions, none of it seemed to have anything to do with what the Coastal Commission regulates. It was all about, he makes these political posts that we don't like. So it was basically government mobilizing to hurt someone they don't like for their political views, not necessarily for any rational Coastal Commission reason. So I found that interesting. And the fact they were just willing to say that out loud. This wasn't a gotcha recording at a coffee shop with one of the Coastal Commission members. This was in an open hearing. They were saying this stuff. And if anything tells you these guys shouldn't be in charge, that is it. It's just super frustrating. Now, I was going to go into that next, but let's go into this next first. So here we are with interest rates. And I took the average home price, $1.5 million, $1,520,000, assuming a 20% down, which would mean you'd have to come up with $304,000. The lowest payment on that is a 6.673 interest rate and $6,000 in fees. That ends up with a $7,786 a month payment, which in my head is crazy. But if we take this down to 10%, which is far more common, look at how this changes. Now, first of all, the number of lenders who will lend to you drops, right? And so suddenly you're getting a 7.319% interest rate, still with $700 in fees, but a $9,216 a month mortgage. Just insane. Let's see, 20%. Now let's look at 25, because if you can swing it, typically you see a pretty good drop in interest rates. Nothing really sexy here at 25%. But as I go through and I run numbers with my current lender of choice, I find I tend to get a much better rate if I'm doing 25% instead of 20. So the best rate, 6.548 or 6.5. Best rate, 6.625. So, yeah. Anyway, and that makes sense, right? It's less of a risk with the more money you put down as a buyer. It represents less risk for them. Next, let's take a look at the reVenture map. Now, this is the new service that I'm subscribing to for real estate data. I share this from time to time on X, so feel free to follow me on X if you like. If you go to soldbyrobert.com, there are all my socials up there in the upper right hand, so you can feel free to find me at any of those. But let's see here. We can see what's happening with home values. Some of the things, let's see. I found the overvalued one to be interesting. Here's not overvalued right here, and it's telling us we're 26.6% overvalued. And I would really want to get more math on that. But what they're basing it on is overvaluation percent is calculated by comparing the area's current value over income ratio to the long-term average. And let's go salary to afford a house. Here we go. This is one I shared. So the household income would have to be $386,416 to make it happen, with a $9,660 mortgage payment. I mean, that if there's anything, and this is one that gets a little bit more separated from just data, this is not sustainable, right? Something has got to give. And this is where it's got to give. I mean, look how much we're up just in the last couple of years. I mean, it's absolutely nuts. So it feels like something's got to give. In terms of the investor forecast is poor. So they're anticipating not great stuff happening. Long-term growth is considered average. Their affordability is still at 0. So I find that super interesting. Buy versus rent differential, 180%. Just all of these numbers are insane for folks who are trying to get housing. So I just thought that was interesting. Next, I have hit all the big things that I wanted to hit today. If you've got any questions, feel free to ask. Always happy to answer or have a chat about something that interests you relating to real estate or talking about other markets. As I mentioned, We've got access to data for the entire country. I am super interested in this area. I think I've even mentioned I've gone there a couple of times now. I was almost going to be doing the show from there this weekend, but I ended up I screwed up my back, so driving for 4 hours and plus, and with the amount of driving I do when I'm checking out a market, not for me. Super love this area. Super love this area. This is where Genoa is down here. But I think these are great areas to consider. So much of this area, if you're someone who's like, well, I don't want to lose out on the California stuff, I think you get so much of the California vibe in terms of scenery and beauty from this area. And look where you are. I mean, you're literally 20 minutes away from South Lake Tahoe. So I think this is a beautiful part of Nevada. Not as much of a fan of the Las Vegas area. But let's see here. That's not Las Vegas. Where the heck are we? There we go. There's Las Vegas. But again, we can look at any market that you might want to check out. So if it's something you'd like to talk to me privately about, feel free to reach out to me. Again, you can find me at soldbyrobert.com. Finally, here's the website, and here we are. See, here's the show going on right now on the front page. If you'd like to find out the value of your home, feel free. I'm on here with my son, was the last one to use the browser, so some of his stuff is here. But go ahead and you can check it right here. So you would just enter your address, check it, and you'd get an instant value. You don't have to give me your email address or anything, but if you want the rest of the information, the rest of the tools that come with it, just provide your email address. And if we look at some of the cool stuff here, you get the home estimator, you get the home equity tool, home purchase options, how to use your equity, a refinance calculator that tracks real interest rates with a local lender so that you can get an idea of if refinancing would work for you and you would end up with a better payment or better terms. Mortgage summary, which kind of gives you an overhead view, just a top-down view of what's happening with your mortgage. Important options of some of your things you could do with your equity or things you could do with your property. Net worth of your home, and home renting tool that lets you figure out how much would I make or not make if I do an Airbnb or a long-term rental. So just great stuff. So feel free to check that out at your leisure. Okay, I think that's about it, folks. Always great to share with you the latest happenings in real estate and our local real estate market. I appreciate you spending some time with me. You've still got time to have a fantastic Saturday as we just crossed the line over to 11 a.m. Again, thanks for listening. My name's Robert Whitelaw, a local real estate broker in Santa Clara County. Always happy to help you reach your real estate goals. Look forward to seeing you all next time where we'll chat about the latest market changes that have happened in November. Thanks again. Talk to you next time.